Hello everyone, and welcome back to this edition of the weekly video markets update from FBS.com after a long weekend due to the holidays in the States in observance of the 4th of July. Today's video will be about currencies, crude oil, and also gold. We'll discuss new signals and opportunity in addition to explaining the drama of OPEC Plus and finally our new signal on gold. But this time we'll dive into the details after a short commercial break without the usual headlines. Beginning with the US dollar index, and I hope that none of you guys are stuck with any long positions from last week, as we warned multiple times, and especially right before the US jobs report, not to rush into buying the US dollar, as the technical indicators are heavily overbought. And we need to see some sort of a retracement to the downside before looking into any new long positions. The US dollar index declined on Friday despite the positive jobs report, including the new jobs, which added over 800,000 new jobs. The wages continued to grow, while the unemployment rate was the only negative outcome in June's non-farm payrolls data. The US dollar index also declined back toward 92 at the beginning of this week, which is a notable support area, which should be watched very carefully in the coming hours, as a breakthrough that support would clear the way for further declines ahead, at least, and this time possibly toward its 200-day moving average, which stands around 92.43. Yet the technical indicators are suggesting a deeper retracement to the downside this time, which may reach the 50% Fibonacci retracement from the recent rally, which began back in May, which stands around 91.13. And this is the first level that we would be looking into some long positions, while the second demand zone stands around 90.76. Therefore, we would prefer for this retracement to be completed first before issuing any long positions, as we noted in our previous reports. Moving to some major currencies now, and let's start with the euro. The euro dollar broke its major uptrend line, which began in March of last year, and stabilized below that trend line throughout last week's trading, with a weekly close below that trend line as well, which is a notable technical development. Yet the pair also managed to bounce back on Friday following the US jobs report data, while it is also nearing the 1.19 resistance area, which also represents the broken uptrend line. This week, the euro may also try to regain above its broken trend line. However, this might be for a short period of time, while we would prefer to spread our short positions in or into 3 stages. The first position would be at the broken trend line, which is around, as I said, 1.19. While if the pair managed to break above that resistance, the next 2 positions would be around 1.20, followed by 1.2030. if it gets there. While we would be looking also for another leg lower, and this time would be deeper below last week's low, with a possibility to test this year's low around 1.17. Another currency to keep an eye on this week is the Canadian dollar, at least from a technical point of view. The USDCAD failed to break above its short-term trend line resistance last week and dropped back below its 100-day moving average with a clear bearish engulfing candle on the daily chart. However, this is not a surprise, and we were also waiting for such a short-term retracement to the downside before the upside move resumes. But in the meantime, the pair is nearing a new buying zone, which stands between 1.2217 all the way down toward 1.2190. And this is where we have our pending orders to long in the coming days. While the target for such position would be over 1.2487, which we considered as our first target, while the second target would be the 200-day moving average this time, which stands around 1.2656. I understand that also sometimes it is boring to keep waiting, but I would rather wait for the trade to come to me than chasing an upside move. Let's move a little bit away from the currency or currencies market, and let's look at the latest development in crude oil, which spiked again and to the highest level since 2018, including, of course, Brent and West Texas crude. But such rally comes on the back of OPEC Plus drama over the past few days, which was kind of shocking and surprising to the markets. The UAE blocked the deal as they are calling for a plan to end the COVID-19 agreement, stating that 1/3 of the country's production is actually paused because of OPEC Plus deal. On Monday, OPEC Plus abandoned a planned meeting in order to try to reach a deal, and at the same time with no announcement on an upcoming meeting anytime soon, which again fueled speculations over the future of OPEC and OPEC Plus. Such drama, if it continues, would also not have an effect on oil only, and this would weigh on the global markets as well in the coming days or in the coming weeks, especially if there's no date to be set. Especially if OPEC failed to reach an agreement, which may actually lead to what we call it as a price wars, if countries started to increase productions without any kind of deal between the oil producers. Yet at the same time, we are actually used to such drama. It is not something new. We have seen many episodes of OPEC or OPEC and OPEC Plus drama in the past, and even during COVID-19, but at the same time or at the end, they were able to reach some sort of a compromise. But will this be any different? It might be, especially that the UAE and Saudi Arabia are strong allies, and the conflict was not something we are used to at all. Therefore, traders need to be very, very careful over the next few hours and the next few days, as any announcement would either lead to a stabilization or a chaos. Finally, let's talk a little bit about gold, as we issued new long signals yesterday through our written reports in Arabic and in English. And in today's video, we will just explain why and what are we looking at. Last week, gold broke below the key support area that we mentioned in our previous video, which stands around $1,769 an ounce, reaching as low as $1,750. However, it also managed to recover quickly, and the next day. So far, gold has been rising for the past at least 5 sessions in a row, including yesterday's session. But the bounce back was one of the first positive factors on the short term, while the technical indicators were heavily oversold on most time frames. In the meantime, we need to see a clear stabilization above the $1,800 an ounce in the coming days and in the coming hours, which would put our long position in a good place. And we can even raise our stop to a break even just to protect these positions from any potential loss if gold failed to stabilize above the $800 an ounce. The long positions was at between the 1,770 and 1,780 and are already in profit with a stop loss at 1,750 for now, while a stabilization above the $1,800 an ounce may lead to further gains, possibly this time toward its 200-day moving average, which stands around $1,830 an ounce. And these are not only on the short-term positions, but on the medium term as well. Meaning we might actually keep these positions or keep holding them for weeks and maybe months, just like the ones that we issued back in April and closed them in June. This is it for this short weekly video market update. I hope that you guys enjoyed it and found it informative. And please subscribe to this channel and activate the notification so you would get notified once there is a new video on our channel. As always, follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. I'll see you once again next week. Have a good one.